So this is the walkthrough of the in-class quiz. Problem 1. Fit and Slim is a health club that offers members various gym services. Assume F&S offers a deal whereby enrolling in a new membership for $700 provides a year of unlimited access to facilities and also entitles the member to receive a voucher redeemable for 25% off yoga classes for 1 year. The yoga classes are offered to gym members as well as to the general public. A new membership sells for $720, and a 1-year enrollment in yoga classes sells for $500 additional. F&S estimates that approximately 40% of the vouchers will be redeemed. F&S offers a 10% discount on all 1-year enrollments in classes as part of its normal promotion strategy. How many performance obligations are included in the new member deal? Okay. Whoops. Okay, so there's a total of 2 performance obligations in the contract. Why is that? Well, you got the unlimited access to facilities and classes for 1 year. That's one performance obligation. Because the discount voucher provides a material right to the customer that the customer would not otherwise receive, which is a 25% discount rather than the normal 10% discount, it is considered a second performance obligation. It's capable of being distinct because it could be sold or provided separately, and it's separately identifiable. Okay, so 2 total performance obligations in the contract. Part B, how much of the contract price would be allocated to each performance obligation? And we should explain that answer. Okay, so this is what the allocation looks like, and then I'll explain it. Okay, so to allocate the contract price to the obligations, first step is to consider that that the company Fit and Slim would offer a 10% discount on the yoga course to all customers as just part of the normal promotional strategy of the company. So this 25% discount that's spoken of here provides an incremental value of 15%, meaning 15% greater than what the normal discount is. So the estimated standalone selling price of the course voucher provided by F&S is $30. And the way you get to that is the $500 initial price of the course times 15% incremental discount times the 40% likelihood of exercising that option, and that gets you to the $30. Okay? Then we have the standalone cost of the new membership, which is $720. So that's the other part. Total of those two together, $750. Okay? Part C. Prepare the journal entry to recognize revenue for the sale of a new membership. Clearly identify revenue or deferred revenue associated with each performance obligation. So to do this one, we're going to look at what we figured for Part B, and we're going to take these numbers and first of all, we're going to take them, and of the $750 standalone prices, we're going to figure out what percentage of that $750 is allocated to the discount voucher and what percent is allocated to the gym membership. Okay, the way we do that is we're just going to, we know that the total is $750. So what percentage is 30 of 750? Well, 30 divided by 750 is 4%. Okay, so if we change that to percent, there you go. And I'll just write that in here. Percent allocated to discount voucher. Okay. Then we want the percent allocated to gym membership, since those are our 2 obligations. And we get that by just taking the 720 divided by 750 and then I'll change that to a percent. Okay, so now I have 96% allocated to membership, 4% to the discount voucher. Now I'm going to take those percentages and use those to calculate how much of the new member fees of $700, which you see back here, how much of that $700 should be allocated to the discount voucher, or the amount that's going towards having this extra discount, and how much should be allocated to the actual gym membership. Okay, so $700, I'll put that in here, $700, amount of new membership. Okay, so how much of that $700 is 4%? Equals 0.04 times 700, $28 to discount voucher, and here equals 0.96 times 700, 672 to membership. Okay, now that I have the amounts, I just need to know how the journal entry should look. Okay, so obviously debit, credit. So we got a debit to cash for $700. That takes care of the debit side. Then the credit side is going to consist of two components. Both of these are going to be deferred revenue. So we'll have deferred revenue attributed to membership fees, and whoops, I guess I should go ahead and put the amount there, yeah. Membership fees is going to be $672, and deferred revenue for discount coupon, whoops, and that we said was going to be $28. Okay, and then we would obviously, since this would be over a period of time, we would then, as that time period went by, we would recognize that not as deferred revenue, but as earned revenue. Okay, so this is what the journal entry would look like, and that is part C. Moving on. Problem number 2. In 2016, the Westgate Construction Company entered into a contract to construct a road for Santa Clara County for $10 million. The road was completed in 2018. Information related to the contract is as follows. You have the information related to each of these components for each year, and we're given the information here that Westgate recognizes revenue over time according to the percentage of completion. Okay, so using that information, calculate the amount of revenue and gross profit to be recognized in each of the 3 years. Okay, so for 2016, when I calculate the amount of revenue, we'll do all the revenue first, and then we'll move on to gross profit. Okay, so 2016, how do we calculate the amount of revenue that we are going to recognize in 2016? Well, we're going to look at costs incurred during the year, okay, and we're going to look at let's see, what other information are we given here? So costs incurred during the year, estimated cost to complete the whole project at the end of the year. Okay, so if we combine these two, that's our, as of right now, our estimated cost to do the whole project. Okay, so what's 2,400,000 plus 5,600,000? So let me just write that out here. Total costs estimated as of 2016 equals, in this case, whoops, 8 million. Okay, that's just adding those two together, 2.4 plus 5.6. Okay, then we're going to say, okay, of that 8 million, what percentage of that is 2.4 million, which was the amount we incurred during this year? So, if I do a calculation here, what percentage of 8 million is 2.4 million? So I'll do equals 2,400,000 divided by 8 million equals 30%. So I'll just change that to a percent real quick. 30% is the percent completed as of 2016 using the cost divided by total cost method of calculating that. Okay, so then we're going to take that 30% times total value of contract, which in this case is 10 million, equals revenue for 2016. Okay, so obviously don't really need to calculate that. We should be able to sell 30% of 10 million is 3 million revenue recognized in 2016. Okay, so we're going to use that those same ways of calculating to look at the remaining portions of these years. Okay, so for year 2, we've got costs incurred during the year, 3.6 million, and we also have already had 2.4 million. So if we add those two together, total cost to date is 6 million, and we still are estimating it's going to cost 8 million overall. Okay, so generally, if you have total cost, you have total cost minus what we already incurred would give you the costs incurred this year, which is 3.6. So again, we're going to try to figure out what percentage of the total costs did we incur during 2017. Okay, so we got 3.6 equals 3,600,000 divided by 8 million, and that gives us 45% is the percent completed, but this time in 2017. Okay, so again, we would say equals 0.45 times, okay, so that is 4.5 million. Oops. Okay, and then if we look at, let's see, that was 2017. So for 2018, we want to look at where are we at here? 2.2 was what was incurred during the year. Add that to what we've already incurred. Okay, so we have 2.4 plus 3.6, and that equals 6 million plus 2.2. So now, instead of 800,000 being my denominator, we actually incurred 200,000 more than what we estimated we were going to incur. So now we have, let's see here. Yeah, okay, so now instead of looking at, since this is the last year and it's completed this year, we're again, at this point, not really worried about the percentages anymore because we know that we are going from 75% complete to 100% complete. We'll get to the fact that we incurred $200,000 more cost later, but we don't use that to actually calculate the recognized revenue for this year. So all we really need to look at is 30% plus 45%, that's 75%, leaving us with 25%. Whoops. 25, whoa, having trouble here. 25% is the percent completed in 2018, and we can say 2.5 million of revenue recognized in 2018. Okay, that's the revenue side. Now we want to look at the gross profit or gross loss side. So there's a couple ways of doing this. And let me adjust here. I'm going to show you the easiest way, at least I think the easiest way. Since we've already calculated revenue recognition for each year, we're now just going to go back in and look at the costs incurred each year, and we'll subtract for 2016 costs or revenue minus costs, and same for 2017, 2018. Okay, so gross profit 2016 equals 3 million in revenue minus 2,400,000 equals a gross profit of 600,000. For 2017, we had 4.5 million in revenue minus 3.6 million in costs, which leaves us with a profit, gross profit of 900,000. And then for 2018, we recognized 2.5 million in revenue. We'll subtract out actual costs of 2.2 million, and we're left with 300,000. 300,000 in gross profit. Okay, so once you do revenue, it's pretty easy. You just look at actual costs and subtract out that way. Okay, moving on. Part 2, prepare all necessary journal entries for each of the 3 years. Credit various accounts for construction costs incurred. Okay, so we're told first that for construction costs incurred, we're going to credit various accounts. Basically, we don't want to mess with each individual small account. So, and for each of these journal entries that we do, there's going to be one for 2016, 2017, 2018. So I've done a little bit of the formatting already. Throw that on there. So for 2016, 2017, 2018, we're going to have a debit to construction in progress, a credit to various accounts. Okay, and so these are where we're going to put the costs, actual costs incurred for each one of these years. So that gives you the amount. So it's going to be 2,400,000. Credit 2,400,000 for 2016, which we got from right there, and 3.6 and 2.2 for the following years. Okay, so we have 3.6. And finally, 2.2. Okay, so there we have basically the storage of our various construction costs incurred year to year. And the next set of journal entries we want to do is to account for us billing out to the customer during each individual year. So we'll have, let's see here, a debit to accounts receivable and a credit to billings on contract. Okay, so this can be a little confusing. Your book describes it pretty well, but first of all, I guess the thing to look at is information we're given. It shows what the billings are each year, how much we billed out to this customer. Okay, so the amount is not really in question here. Why do we do debit to account receivable and a credit to billings on contract instead of like a credit to, for instance, like typically when you do an accounts receivable, you would show, okay, credit to revenue, showing that we earned the revenue or whatever, sales revenue, construction revenue, whatever we wanted to call it. The reason is because in this case, since we're tracking the value of this project on our own books as construction in progress, which is an asset account, okay, if I also tracked this accounts receivable during the same year for, in this case, the amount's going to be $2 million because that's what we billed out, then what would our balance sheet look like at the end of the year? Well, it would be reflecting one asset, construction in progress, showing that basically we haven't turned the title over of this construction job until it's completed. So we'd be tracking that asset and also accounts receivable for $2 million. So it's not exactly double, but in this case we would almost be doubling the amount of assets that we had during the year if we didn't, instead of recognizing revenue here, instead of that, what we're doing here is plugging the balance of this journal entry into what's called a contra asset account, which basically serves to lower this $2 million on our balance sheet, showing that we're basically not going to double our assets until we turn over the value of, or the title of this asset to the customer. I know that can be a little bit confusing, but that's the justification for using this account rather than some type of revenue account. Okay, so then we just look at the amounts for the next 2 years. So we had $2 million the first year, $4 million, and $4 million. Okay, so 2017, $4 million, and 2018, $4 million. Okay, next journal entry that we want to do is to debit cash, credit accounts receivable for, if we look back at the facts here, we receive a certain amount of cash based on our billings for the year. So that amount we're going to want to show as an increase to cash and a decrease to accounts receivable. But remember again, even though we received that, that doesn't lower this billings on contract contra asset, so we're still balancing out the effect of essentially double counting assets by leaving that in there. And we're given the numbers on that, 3.6 and 4.6. Okay, 4.6, whoops, there we go. The final set of journal entries that we're going to do are going to actually recognize the revenue and the costs that we already figured and the gross profit. So this is what the journal entries will look like. So we've got a debit to construction in progress, a debit to cost of construction, and a credit to revenue from long-term contracts. Well, the credit portion you should be able to understand. The revenue portion should be able to understand pretty easily because that's what you would do to recognize revenue in almost any scenario is you credit some type of revenue account. No different here. Okay, so I'll enter the revenue amounts first this time. So we'll have 2016 $3 million in revenue. We'll credit that amount. 2017 $4.5 million. And 2018 $2.5 million. Okay, so that's the revenue side. And then cost of construction essentially just captures what you would normally capture in a cost of goods sold. So the actual costs incurred for each year will show up in this account. Okay, so the $2,400,000 in costs for each year will show up on the debit side down here. Okay, and these are our actual expense type accounts for each one of these categories. So there we have that one. Okay, and then the difference between those, the balancing portion of this, is where we would record the gross profit for each of these years. Okay, so it's going to be the difference, obviously, to balance it, it's going to be the difference between revenue and costs, and in this case, $600,000 is the gross profit. It goes in construction in progress because, remember when I was talking about the whole reason why we do billings on contract here, not double counting assets. Well, the construction in progress account is going to track the value of this asset until we transfer the title to someone else. So we're essentially saying we recognize $3 million worth of revenue, and so now we just want to adjust the value of this construction in progress account to not only show the cost to us, but also the revenue that it generated. So that's why the debit to construction in progress for the gross profit amount. So again, we'll just use the difference between the two for the other 2 years, which again is just the gross profit for that year. Okay, so those are the journal entries for each of those years that we need to do for each year. Okay, one last comment before moving off of this portion. When we talked, when the question says to use various accounts here for the credit portion here, I realized just now that this is the only one that I haven't really explained in detail. This is various numbers of asset accounts that we used up in making this happen. So this could be cash, direct materials, all of the assets that we had to use. So cash to pay for like salaries, that type of thing. Materials if we use direct materials instead of cash. Just various asset accounts that went into making this happen. So these are asset accounts that are going down because they are credited here. Okay. Next question, next portion of the question. Prepare a partial balance sheet for 2016 and 2017 showing any items related to the contract. Indicate whether any of the amounts shown are contract assets or contract liabilities. Oops. Okay. So this requirement is pretty straightforward. So let me just copy and paste here in the partial balance sheet, and we'll talk about it a little bit here. So obviously 2016, 2017, we've got accounts receivable in 2016 for the amount of billings that went out there. accounts receivable in 2017 for $600,000. Construction in progress, you saw how we calculated that already. Less billings. These are all current assets, by the way. Billings in each of those 2 years reduce the construction in progress account, and so costs and profit in excess of billings are just CIP minus billings equals costs and profits. Okay, so we're left with accounts receivable and costs and profit in excess of billings as our 2 main components of this abbreviated balance sheet for each of the 2 years. Part 4. Calculate the amount of revenue and gross profit to be recognized in each of the 3 years, assuming the following costs incurred and cost to complete information. We have information there for each of the 3 years that is relevant. So again, first we want to, this is basically going to be coming back to part 1 here, and we're redoing this for revenue and gross profit, but with new numbers, right? So, okay, so now we still want to figure out, okay, based on year 1, we're estimating that we have 2.4 plus 5.6, that's 8 million. So out of 8 million equals 2,400,000 divided by, we still have 30%, right? Because the first year costs are going to remain the same. So for the first year, we'll change that to a percent. We have 30% times no change to the revenue, or no change to the overall value of the contract. So the first year's revenue is going to remain the same. Times 10 million equals 3 million 2016 revenue. Okay, year 2. Okay, this is where we get some changes, right? So in year 2, we're going to add these 2 together, so that's 3.8 plus 2.4 is 6.2, but now our estimated cost to complete has increased. So now costs incurred divided by cost to complete, or by total cost, would be 6.2 million is what the total costs incurred to date are, divided by what's 6.2 plus 3.1, that's 9.2. Okay, so we'd have 6,200,000 divided by, let's see, all right, divided by 9.3 million. Whoops. It doesn't like the commas in there. Okay, so we'll change that to a percent. We got approximately 67%, which is actually, let's see if it lets us. Okay, let's change that, and we'll go over a few decimals there. So 66.6666 repeating, and so that's the percentage so far times 10 million minus 3 million, because we already recognized that, equals 6.6667 minus 3 million. So now we'll say 3,666,667 whoops, revenue 2017. Okay, and then now the remaining balance is just going to be 10 million minus everything that we've recognized so far, which is 3 million plus 3.667 million. So that is 6,666,667. Whoops. Which leaves us with 2018 revenue being 3,333,333. Okay, so those are our revenue numbers for those years. So then, for gross profit, again, all we're going to do is take the revenue numbers we just figured and subtract out the costs for the year. 2016 gross profit equals 3 million minus 2,400,000 equals 600,000 gross profit. 2017 gross, I will say gross profit, but to give away the answer here, it's actually going to be a gross loss because we have 3.667 or 3.666667. Write that all the way out so that we're not confused. Minus cost for the year right there, 3.8 million. Equals gross loss of, oops, 33,333. Oh, sorry. Too far there. Not 1 million, but 133,000. Okay. That look right? Yes. Okay. So gross loss for year 2, $133,333. And then, oops, 2018, back to gross profit again, equals revenue, which was 3.333 repeating, minus what we got right there for costs, equals 133,000, but positive this time. Okay, and that's the end of that question. So nothing really changes. This is just showing you if we change the costs around, we do recognize a gross loss in year 2. So part 5. Calculate the amount of revenue and gross profit to be recognized in each of the 3 years, assuming the following costs incurred and costs to complete. Okay, so again, looks very similar to what we just did here. Okay, so step 1. Actually, we already know since costs incurred and estimated costs to complete are the same, we know that 2016 revenue is going to be 3 million because it's the same as what we did in the first 2 examples of that. 2017 revenue. Okay, so now costs incurred, we've got again 2.4 plus 3.8, that's 6.2 million, but now we have 4.1 left over. So we have divided by 10,300,000 okay. That gives us, we calculate it over here, that will just be equals 6,200,000 divided by 10,300,000 equals 60% approximately. We'll multiply that times 10 million. We get, let's just round that. Whoops. We get 6,019,417. From that, we're going to subtract 3 million. Equals this minus. We'll change that to $sign there. Whoops. Alright, whatever. Won't be exactly looking the same. We're going to round that. Okay, so this would be our answer. I'll put that in bold. 2017 revenue, 3,019,417. And then 2018 revenue equals 10 million minus 3,019,417 equals minus there. Whoops. Also minus 3 million. I want to include everything we've done so far, and we're left with 2018 revenue of 3,980,583. And again, for gross profit, we just take each year's revenue minus costs incurred during that period. Okay, that should look very familiar to you because it's the same as the last two times we calculated it. This should also be obvious to you that it's going to be a loss given what we calculated for costs and revenue for year 2. So we're going to have minus costs incurred during that year equals loss of 780,583. Let's see here. And finally, 2018 gross profit equals 3,980,583 minus 3,900,000 equals $80,583. Whoops. Gross profit for 2018. So that's the end of that question. Problem number 3. Citation Builders, Inc. builds office buildings and single-family homes. The office buildings are constructed under a contract with reputable buyers. The homes are constructed in developments ranging from 10 to 20 homes, typically sold during construction or soon after. To secure the home upon completion, buyers must pay a deposit of 10% of the price of the home, with the remaining balance due upon completion of the house and transfer of the title. Failure to pay the full amount results in forfeiture of the down payment. Occasionally, homes remain unsold for as long as 3 months after construction. In these situations, sales price reductions are used to promote the sale. During 2016, Citation began construction of an office building for Altamont Corporation. The total contract price is $20 million. Costs incurred, estimated costs to complete at year-end, billings, and cash collections for the entire life of the contract are given in this table. Also during 2016, Citation began a development consisting of 12 identical homes. Citation estimated that each home will sell for $600,000, but individual sale prices are negotiated with buyers. Deposits were received for 8 of the homes, 3 of which were completed during 2016 and paid for in full for $600,000 each by the buyers. The completed homes cost $450 each to construct. The construction costs incurred during 2016 for the 9 uncompleted homes totaled $2,700,000. Requirements. Number 1, briefly explain the difference between recognizing revenue over time and upon project completion when accounting for long-term construction costs. Okay, so recognizing revenue upon completion of long-term construction is the equivalent to recognizing revenue at the point in time at which delivery occurs. Recognizing revenue over time requires you to assign a share of the project's expected revenues and costs to each construction period that it's in progress, basically. The share is estimated based, again, on the project's costs incurred as a percentage of the estimate that we've made of the completed costs. Okay, so I don't want to write all of that out, but we'll just say upon completion, same as when delivery occurs, over time requires periodic recognition based on costs incurred versus total estimated costs. Okay. Answer the following questions assuming that Citation has concluded it does not qualify for revenue recognition over time for its office building contracts. Well, if it doesn't qualify for revenue recognition over time, what does that mean? That means that it's going to have to recognize only upon completion of the project. Okay, so if that is the case for revenue recognition, how much will be reported as recognized revenue? It's pretty easy. You can count it with 2 fingers. 0. Okay, and picture me making a 0 with my thumb and my pointer finger. Okay, it's not complete at the end of either of those 2 years, so how much do we recognize? Nothing. Okay, Again, if revenue is not recognized until completion, well, how much gross profit or loss do we recognize? Pretty easy again, 0. Okay. We would have to report an overall gross loss on the contract if we estimate or determine that the estimates will show that eventually we're going to have a loss. In this case, we're not estimating that there will be a loss, so we're going to stick with that 0. And then C, what will citation report in its December 31st, 2016 balance sheet related to this contract? And again, as we did before, we're ignoring cash. Okay, what's it going to report? This is what it's going to report. Okay, current assets, accounts receivable, $200,000. Already talked about why that is. Costs, $4 million in excess of billings, which is 200,000, or I mean 2 million. Sorry, equals 2 million, and we got 4 million there because if revenue is recognized upon project completion, this account would only include the costs of $4 million. Component 3, requirements 2A through 2C, so we're going to do the same thing again, but assume that citation recognizes revenue over time according to percentage of completion instead of upon completion of the contract. So I'm not going to spend a lot of time walking you through this. This is just like what we did in the previous question. So again, we're taking revenue earned is total revenue, which is the 20 million multiplied times whatever percentage of costs incurred divided by estimated total costs. That comes out to 5 million. Here, 13.5 divided by 18. We've revised total costs there times 75%. Equals 75%. Times 20 million, that gives us 15 million. Now, moving on to gross profit for 2016. Whoops. Okay, for 2016, we had gross profit of 5 million minus 4 million, or 1 million. Just based on costs there and using the gross or the revenue that we recognized here. And then same thing for 2017. So pretty straightforward, assuming that you got the concept when we talked about it before. So moving on, requirement 4, assume the same information for 2016 and 2017. But that as of year-end 2017, the estimated cost to complete the office building is $9 million. Citation recognizes revenue over time according to percentage of completion for its office building contracts. How much revenue related to this contract will Citation report in the 2017 income statement? So here's what the calculation looks like for that one. And you can probably tell that I'm getting tired of talking here, so I'm going to kind of rush these last few. I'm assuming most of you didn't get this far anyway. But part B, what is the amount of gross profit or loss to be recognized for the Altamont contract during 2017? And this is what that one looks like. Part C, what will Citation report in 2017 balance sheet related to this contract? Again, ignoring cash. What will that look like? Look like this. Calculations, 2016 costs 4 million plus 2016 profit 1 million plus 2017 costs 9.5 million minus 2017 loss 3.5 million. When should citation recognize revenue for the sale of its single-family home? Well, I would say that citation should recognize revenue, in this case at the time of delivery, when the homes are actually completed and the official legal title is transferred to the buyer. Recognizing revenue over time in this case is inappropriate because we're not meeting all of the criteria for revenue recognition, because the customers are not consuming the benefit of the seller's work as it is performed, which is criteria 1. Customer does not control the asset as it's created, which is criteria 2. And the homes do have an alternative use to the seller, and seller does not have right to receive payment for progress to date, which is criteria 3. Until completion of the home, the transfer of the title does not occur, and the full sales price is not received, so control of the homes has not passed from citation to the buyers. So I will abbreviate that by saying at the time of delivery. Okay. What will citation report in its 2016 income statement, 2016 income statement and 2016 balance sheet related to the single-family home business? On balance sheet, again, ignoring the cash component. And this is what that would look like. Oops. So if you've stayed with me this long, congratulations for making it to the end. And let me know if you have any questions before the quiz. I will say the quiz does not go nearly in depth on any one component as this. There's no questions that say that, start with one company and walk you through all of these different scenarios. It's basically picking out maybe one component of each one of these questions as an individual fact pattern and question for the quiz. And I would say about 1/3 of the quiz is going over the ratios. So it's just plug and play as long as you have the correct ratio and can plug in the numbers.